In today's show, we'll be talking about whether now is the right time to sell your company and what Gaurav and Colin are seeing in SaaS company valuations. Today, I'm thrilled to be here with Gaurav Basine, the Managing Director of Allied Advisors in San Francisco, and Colin McNeil, who is the M&A Tech Lead Partner at EY. Colin also runs EY's Entrepreneur of the Year program in Australia. And combined, these two have over 40 years of experience in helping SaaS companies through the M&A process. Welcome to Bootstrapped, the lighter side, the podcast for B2B startup founders wanting to achieve success without giving up ownership or control. This podcast is brought to you by Lighter Capital, the leader in founder-friendly financing for B2B SaaS companies. Learn more at lightercapital.com. All right, guys, welcome.
Thanks for having us.
So look, the question I get asked, you're both familiar with Lighter, but we've done over 1,200 rounds of financing, almost all the B2B SaaS companies. So many of them have gone on to have successful exits. But one of the questions that I get asked very frequently is this the right time to sell my SaaS business? And how much is it worth? And a lot of entrepreneurs seem to believe there is one price and they want to know exactly what that is, even before they go into a sales process. So I imagine as much as I get asked this question, you're asked it 100 times more. So how do you answer that? And is this the right time? And what are SaaS companies worth these days?
Yeah, good question, Melissa. When we meet prospective clients, when we get asked this question, we kind of try to understand what the situation is. In some cases, the founder is bootstrapped. They've grown the company to 5, 10, 15 million ARR, and they feel that, to grow, they need investment to build up the GTM functions. Some founders are not the type who's going to build it to 100 million. We say, okay, this might be a good time to find a big partner who can acquire you, get the distribution. In some cases, if they're venture backed, there's like a sort of sequence. Every 18 months, they got to raise funding. So every time they come to this inflection point, you have to ask them, are you better off raising funding or are you better off going on the exit route, right? In some cases, they may be inbound in the company, right? And it's when you have inbound, it's probably a good time to consider sale process. Or in some cases, the market might be consolidating around you. So, there are many, many factors that come into it. So we kind of ask every entrepreneur, we have this candid discussion with them, and then based on that, advise them what to do.
In reality, when we get the question, it depends, because people are always fixated on what's the market conditions looking like, and is a strong activity, and are we seeing strong just general bidder interest in acquiring? That's fine, but there's also a question to ask: are they ready for an M&A transaction? Have they got all the preparation steps in place? Are they going to be able to be scrutinized and provide a buyer with the necessary information to give them the confidence to acquire? So there's two aspects. One is the market looking pretty good, and then the second is that business ready to even undergo a transaction? I think at the moment, if you were to ask me, I'd say market conditions are okay. They're certainly better this year than last year, whether it's global or in Australia. We are seeing a pickup in deal volumes. It's roughly 20% year on year for the sort of first half of the year versus the previous first half of the year last year. So yes, on the face of it, the market conditions look pretty good. But does that mean the business is ready to undertake a transaction? That's a completely different conversation. And then valuation itself is another conversation on top of that. And there's so many factors that determine what's the valuation. I think my number one sort of recommendation would be speak to an advisor in that situation if you want to know what you're worth, but and also trust in what the advisor says. Often when we give that sort of recommendation, we get the pushback of, well, I've seen other companies worth being traded at such and such a multiple that's a lot higher. And there's influencing factors that go into that. If you're dealing with experts that sort of do this on a day in, day out basis, trust in the advice they'll give you.
Yeah, definitely. We have seen a big improvement in the market from 2022, 2023. Just to give you a sense, Melissa, this year we had the biggest VC-backed exit with exiting to Google. We have had some good exits in the AI space. OpenAI just did a multi-billion-dollar deal. And even coming down to kind of the mid-market M&A, which is really where all of us focus, the valuations have stabilized. It's obviously not where it used to be, where the Bessemer SaaS index was 16x for the public company multiples are right around median of 5x. That I would say is a good anchor point to kind of think about. And obviously, you as a company can trade north of that if you are growing nicely, if you have some proprietary technology or something very interesting that people will pay multiples beyond what those sort of anchor points tells you.
Yeah, and there's a couple things. One, I have to say, Colin, this is like the most positive I've heard you on the market in a long time. So that's great. For Colin to say okay is like a normal person saying it's phenomenal. So actually that makes me quite bullish. So on the valuations, yeah, you had mentioned median multiples around 5. I mean, I just looked at median multiples for public SaaS companies are 5.9 to 6.3 times revenue today. But how much should you, as a private SaaS company, which is, virtually almost all of Lighter Capital's portfolio companies, compare your valuation to public SaaS? How good of a benchmark is that? And if you can't use that, what do you use? Because where do you get the information?
I think Melissa is a good starting place, right? It kind of, okay, public companies are trading generally at 5 or 6x. You got to look at what sector you're in. Are you in security? Are you in human capital management? Where are the public comps trading there? Oftentimes, the problem is for private companies, the M&A multiples are not disclosed, especially if they are 10 million ARR SaaS companies. They get bought by public companies, immaterial. They don't disclose the multiples. Private equity doesn't disclose it. So some of it, what we tell them is, folks like Colin and I in the market every day talking to buyers. We know what buyers are paying. We know what the strategics are paying. We know what the private equity firms are paying. Based on your growth, based on other factors like retention, other things, we can kind of tell you, directionally where you will trade at. What we tell clients is if you're kind of middle of the fairway SaaS companies, today's market, look at a 4 to 7x multiple, right? Is kind of the way we would say, for planning purposes. And once we know the company based on their growth, their net retention, gross retention, other factors, we can give you a more narrow range. But for planning purposes, that's a good place to start.
That's right, and the reality is it's a sort of a dark art approach to valuation. It's yes, you can sort of have the metrics that are publicly stated, see what transactions have been quoted at as well. That's a limited pool. It's also not perfect information as well, because a lot of the stated deal multiples that you'll see there for transactions aren't really reflective of the actual basis on which they were valued. People will be looking at sort of recurring revenue rates that aren't necessarily the same as published financial revenues, and also looking at profitability that will be different. There'll be normalized profits versus sort of actual profits, and so it's always sort of bit of a sort of mix into the box. And then really what we then do is, as Gaurav mentioned, we sort of know what deals are trading at. We see what processes we're running. We know what investors are looking at. The market intel and insights, that's what you really lean on your advisor for, to give you a view as to where really are the sort of the market pricing coming in on things. But Gaurav's right. You do then have to factor in the non-financial KPIs, the sort of the usual SaaS metrics, because that gets to the underlying quality of the asset as well. Factor all that into your thinking when you're sort of assessing what could you be worth as a business.
And one thing I would add to it, Melissa, is that the best way for you to get optimal value is to run a process, because we have seen wide dispersions where we get multiple bids and one bid can almost be double of the other bid. The only way to do it is by price discovery, and as simple as selling a house in the real estate, you want multiple folks to look at it and get a bid.
One of the biggest mistakes I see entrepreneurs making is not running a process, being approached, thinking this looks really good, and then not really finding out what else is out there in the market. Today, would you say strategic acquirers or private equity firms are more active?
We did a query in PitchBook recently, and when we look at it, strategics are still the dominant acquirers of companies. About 65% of the deals are done by strategic. Private equity is about 35% last year. Having done this for 20 years, when I started my career, less than 10% of the deal was done by private equity. That number has steadily grown because private equity likes the recurring nature of tech. They understand tech. There's $1.5 trillion of dry powder in private equity, so they are growing as a buying class. But by and large, strategics dominate, and the reason is they have a lot of cash. The reason is technology changes fast. They need to acquire these companies to keep innovating. Otherwise, if they don't innovate, they can become less relevant. And also with the strategic, they have a big advantage. If you have a company that has got this product market fit with their distribution, they can pretty quickly take the company from 10 million of ARR to 100 million of ARR quite quickly. Private equity, on the other hand, can't do that. They are restricted because they have the mandate. You have to go after a sector, you have to go after certain size of deal, certain retention metrics, otherwise we won't do it. Plus the cost of debt has gone up too. So they kind of impose all these things on them, so they can't move as quickly. And with strategics, they can also have some synergies with revenue and cost synergies. So by and large, strategics are the dominant factor, but it's good to see private equity becoming more and more active. And that's what we've seen in our deal flow as well.
I think the one thing just to add to that, the buyer class as well that we are seeing rising is sort of the hybrid of that. We are seeing a lot of strategics that are actually backed by private equity, and this is particularly true in Australia, coming into the market to acquire because they can get behind the high performing platform assets that they own and deploy further capital into a market where there is still probably a scarcity of quality platform assets, new investments for them to make. And so that is certainly a buyer group we are seeing on the rise as well in terms of deal flow in this market.
Yeah, that's an important point. They're not mutually exclusive necessarily. As advisors, who would you rather be negotiating with for a company, a strategic acquirer? And in this case, we'll call a strategic acquirer either a competitor of yours, someone in the same space, or a larger company that's trying to bring in certain technology or products, versus a private equity firm that could be doing the same thing, but might be doing a roll-up or really looking at a financial acquisition.
Generally, strategics are easier to deal with than private equity. No, I think strategics, if the technology fits, if a company is doing 10 million ARR, I've sold companies to folks like Apple, IBM, and others, the revenue is meaningless. So the diligence is easier from a financial perspective. The private equity guys are going to do quality of earnings. They're going to bring their armies of folks. EY has a good diligence team. We are doing a deal where they've got EY and they're doing a great job with diligence. With strategics, they don't do as much. For them, a lot of the focus is on the tech and the entrepreneurs we advise. The tech tends to be, cutting edge, AI native, cloud native, born in the cloud, new companies. So they are easier to deal with. They also seldom, retrade. Whereas the private equity folks, if they find some hiccups in your revenue projections, concentration, diligence, they can come back and do a retrade.
Do they ever not do a retrade? It's really behavior. I want to dig into this
Yeah,
that I see so often where an entrepreneur is given a price and then these little monkeys, I call them the little private equity analysts, get in
sure.
there and they go, well, we thought your churn was, 5%, but we found out it's 5.7%. We'll show you these numbers. Look at the numbers we run. Your churn's 5.7%. There goes a couple $1 million on your valuation. And by that time, the entrepreneur is pretty far down the path. And in fact, we did a panel with a lighter capital company that a bunch of our companies have been acquired by private equity firms. One of our CEOs said that the most value that an advisor brings is they can keep up with the spreadsheeting of the, of the private equity guys. That's a question for you. How often are you seeing retrades with private equity firms versus strategic buyers? And to be clear, retrade means changing the price during the process.
Maybe to defend the private equity community and so, I'd say 95% of private equity are well-intentioned and trying to sort of back up what they're saying that they're going to do and support the deal that they've put forward. If there's a need to retrade, it's probably because some of the initial assertions that have been put forward don't stack up. And you have to sort of, I guess, weigh up at that time, how material is the item that that you haven't supported through the data. That they will crunch data.
But Colin, how often are they changing the price after getting in and digging in the data?
There's certainly a negotiation that happens on a lot of deals, but whether you end up with a change in price, I think that comes down a little bit to the quality of the business, the options it's got, whether you've got a process on foot. If there's genuine competition for an asset, at certain points, private equity do have to take a view on things. ultimately, don't forget, private equity are compensated by investing. They need to deploy capital. They need to make returns. They can't just sit on their hands and walk away from deal after deal after deal. And going through due diligence is a massive drain on their time and resources. They've got to pay for the due diligence without being able to capitalize it as part of the investment that they'll be making. So, they don't want to go down that path in terms of retrading. So I do think that's when you've got to lean on the fact that you've got an advisor that knows hopefully what they're doing to negotiate through that and to maybe push back on the materiality of any changes. A subtle change in churn realistically shouldn't materially change the price and change the overall sort of attractiveness of the asset. As well as if you've got a genuine process or you've got genuine competition for the asset, that does mean that they've got to sometimes look through things. But strategics have the benefit that they can take a more sort of holistic outlook on the opportunity. If they like the tech and they like the opportunity, they can take a view on more aspects. That's certainly true. But I do think there's always a sort of point the blame at private equity. I do think you need to step back and say, well, what really is the reason for the retrade? Because they risk in losing the deal and also harming the relationship going forward, and that isn't necessarily the prerogative they want to follow.
I think probably 1 and 2 will try to retrade. It's just
About 50%.
yeah.
Okay.
Their whole point of doing this huge diligence process is to find some issues which they can try to retrade their price, right? I think where advisor can help their clients is get some of the things ready, like Colin said, in the sale process, right? Make sure you have a clean set of financials. If you're audited, great. You have quality of earnings, great. Customer concentration, great. Third party looking at retention metrics, great. If it's a good company, assuming it's got rule of 40 scale, size, then you run a broad process, you're probably going to get a dozen private equity firms throwing IOIs. Then you tell the IOI guys, hey, look, guys, we got 12 guys. I'm only going to get two of you in, but I don't want you guys to play games. So you have another period of mini diligence you do between IOI and LOI, and then give them a tight exclusivity period, and then let the guys that I'm going with this party, but keep the other guys warm, though you can't talk to them during exclusivity, and tell this other party, look, you may try to take 10% off, but you're going to risk this deal because I got 3 other private equity guys who are waiting, ready to pass. They're pinging me, by the way. Here's the email. I'm not dealing with them, or here's the email on a redacted basis. You're going to lose this deal. Plus, more importantly, this poor entrepreneur is going to come work with you and will roll 30% equity. Do you really want to annoy him by retrading this and starting the relationship on a bad note? And then sometimes people take the bigger picture. And if it is material, this is where the advisor can also step in and say, guys, they went and spoke to your big customer. Your big customer is not renewing. Actually, is going to churn out. So they have a valid reason. And they looked at your tech stack. You have to rewrite quite a bit of it. Your tech debt is huge. There's all the remediation that needs to be done. And these are all the things that need to be done. They got to build up your operational team. This guy is not a good sales guy. These are the facts. Do you really want to kind of go through it? And hopefully the advisor done a good job by juicing the private equity more than where the other bids are, like maybe 20, 30% higher, that you can still absorb a slight price reduction, right? And then everyone can come out ahead. But at the end of the day, you should be able to say no if it doesn't make sense and go back to some of the other parties. And that's why what we try and do is we run a broad process with strategic and private equity. So then you can pick the best. So we're not telling you go to private equity. God willing, you get a strategic, great, let's go for that. But if you don't get a strategic, then private equity is who you're dealing with, because sometimes your time may be too small. Strategic is not interested. IBM is not going to buy a company that's not there. So that's what we recommend.
You had mentioned something earlier, Gaurav, and there's something that I've heard over and over again and probably said over and over again, and that is that companies are bought and not sold. And it has been my experience in 20 plus years in venture and selling 2 companies as a CEO, that the probability of a successful sales process is much higher if that whole process starts because the company was approached versus the company decides, okay, now's the time to sell, without having been approached. What is your view on that?
I have a contrarian view on it.
Okay.
It helps when you have an inbound. About 20 to 30% of our clients have inbound. We run a process that's great. And
do you think there's a higher probability of getting it done if it starts with inbound, or would you say it doesn't matter?
I think there's definitely a higher probability because you already have somebody at the table and who's kind of interested, right? So the probability kind of goes up. That's for sure. But, I think unfortunately the media kind of sensationalizes it. Companies are bought, not sold. And that's the biggest disservice to the founders and entrepreneurs because you're leaving money on the table. Because they go after the Wish deal where Google has been quoting them for 2 years. Thomas Kurian from Google has been paying them and finally pays 30 billion. WhatsApp gets sold. But those companies are the exception, not the norm. You should definitely run a process and try to get the maximum outcome because otherwise you're negotiating with one party, your leverage goes away. Even if you have an inbound and it's a strong inbound, what we tell our clients is, do you really want to do a deal with this? If you want to do a deal with them, let's give them the stick. Make the offer attractive, otherwise we'll run a process. And oftentimes they'll make it attractive for you so you don't run a process. Nobody wants competition. If you're a corp dev person, you're a private equity partner, you don't want the company you want to be shopping. So they'll pay up and close the deal. But I do think you should always run a sale process, whether you're inbound or you're running it cold. That's my take on it.
Yeah, no, I'd agree with that. It's probably, to be honest, it's probably closer to 50-50 in terms of opportunities we step into, whether they've had an inbound that's catalyzed the thought process to sort of explore a sale and then sort of build the process around that. Often say it's to sort of founders, don't get overly flattered though by having inbound interest coming your way, because a lot of the time there are corp dev teams, particularly, this is actually more of a nuance, I think, for the technology sector. Corp dev teams are more prolific in terms of outbound outreaches to try and find who's out there in the market to test what opportunities there could be to acquire. Private equity as well are the same. And so people sometimes come to us saying, I've got this inbox of emails and people that have reached out to me, I've got so much interest. And actually, when you sort of peel back a layer, you find out the interest wasn't that real. They were more just testing what is this business, what's its scale, what's its revenue, and then they sort of walk away. So, don't be too flattered by that interest, and don't get too ahead of yourself in that regard. But yeah, look, a process is ultimately the best way to make sure that you keep buyers honest. You determine that you've got the best pricing as well, and ultimately the market will value you. But it's also a way of just making sure that you can satisfy yourself that when you do eventually sell the business, you really have made sure that you've got the best possible deal, whether that's private equity, strategics, whatever the terms that are surrounding it as well.
Yeah. And one more thing I'll even add is the private equity folks have hired these armies of young analysts, and they will just keep calling people, any company that's operated, they'll get inbounds in private equity. And entrepreneurs get flattered. Oh, I've got XYZ private equity firm that pinged me and it's TPG. I'm like, TPG is not going to touch a company for 10 million ARR. So, again, and oftentimes, you get approached by them, so it may not even be real, but, so agreed.
Yeah, yeah. It's how do you burst someone's bubble? I think especially I see this in Australia where you have, an Australian entrepreneur and they're called by, not just for the sales side, but for a venture investment, called by some analyst at big name VC in the US. And they say, I'm getting 3 calls a week. And I'm like, well, that probably means they've decided to invest in this space. They've already picked the company they're investing in, and they're really just looking at the competitive landscape. But that said, if you don't take those calls, it's going to be hard to raise money or sell your company. So how would you advise companies to, say you're running your SaaS company, you're not for sale, things are going well, but you're starting to get inbound and it could be interesting. How would you advise companies to respond to those calls?
Our suggestion is take those calls, make it a quick 10 minutes, 15 minutes call. I think that's enough time for you to vet if the interest is real or not real.
And what questions should they ask?
They should ask them, if it is a private equity firm, what type of deals do you invest in? What size of companies do you look for? Try to understand if they're the right fit. Pretty quickly, you can figure out in 5 minutes if you're the right fit or not, right? And usually the private equity firm that approaches you, you can tell if they've done their homework because they will usually flaunt about deals they've done in your sector. They have a thematic view on your sector. They've heard about you from a customer, from a portfolio company, so you can kind of use that as a judgment to see if they are the right fit or not. But keep these calls short, get on the radar. For strategics, have that call to, with corp devs, just be careful that don't give too much information because some big companies, I won't name them, they are notorious for copying a lot of it and then building it themselves. So, be careful with trade secrets, but, it doesn't hurt to be on the radar. And one of the things I always say is one of the best ways to get an exit is we work with founders who have known the buyer universe for a couple of years, those processes go quite well because they say, yeah, I know Joe. He has grown the company nicely in the last 5 years. Whereas you go to a process and where your entrepreneur doesn't know anybody, it's a little bit of a harder sale process. So I think developing those relationships, having quick short calls is always a good thing to do.
I agree. Be in listening mode for a large part of the call. They've reached out to you for a reason, so find out why. Definitely when it's a strategic, just don't give away too much. But it's sometimes helpful to build a relationship because even if you're 3 years away from doing a deal, it's still helpful just to build that rapport, build the relationships, get on each other's radar because at some point it might be useful.
Yeah, in M&A, people buy people. At the end of the day, it's always the people's business. If they know you, they've run into your trade shows, maybe you've done a deal together. I think it helps because then you have the business unit sponsor who's going to say, "Yep, this is a great company. We should buy."
I think just to build on that, I would say that it's interesting because sometimes we'll have clients and they'll rattle off a load of names of big people that they think are natural buyers for them, but then the natural buyers have never heard of them. And so it's very difficult to suddenly go from a very cold relationship, not even being aware of the target, to suddenly they're buying you 3 months later. So building that relationship is actually worth it, regardless of whenever you're thinking of doing a process.
Yeah, and one thing I'll say is, I wrote an article in Forbes about this, that the best strategic exits happen when you have a pre-existing partnership, a customer relationship, or an investment. Like maybe Salesforce has invested in you for a period of time. They've worked with you, they've gone to market together. A lot of the deals, they'll acquire you. And you can see this pattern existing across all companies. So where you have a commercial partnership, an investment partnership, those are very helpful. And that's why I wrote that article in Forbes about partnerships are great catalyst for M&As. You date before you get married. So
Well, that goes into what should founders be doing sort of 12 to 18 months ahead of a sale in order to maximize their valuation. I mean, I heard you say, Gaurav, one, form a partnership first with potential acquirers or multiple partnerships with potential acquirers. But what else should they be doing? Say you're a VC-backed company or bootstrapped, and you just decide, look, in the next 18 months, we want to run a process.
So we wrote an 8-pager white paper on this 2 years ago. Basically, with the venture-backed company, they are in this cycle, 18 months, you got to do something. So they are well prepared with their materials, data room, all that good stuff. Yeah, companies, the only thing they do is get customers and pay my bills. That's all they focus on, right? And then they're not keeping eyes open on what's my exit plan, because let's face it, the reality is you're not going to go public unless you're $500 million, and that's very rare. Atlassian is the exception from Australia, didn't raise much, but went public. So what we say is the first thing we do is, get to know advisor in your space, ask them about, where valuations are, right, in the market, get a sense of valuation, get a sense of who your buyers are, get a sense of where multiples are and what your game plan is, right? Once you have that, your advisor can guide you how you'll get there. Second thing we recommend doing is get a good CFO on board or get a third party firm that can put your finances together. Generally, if they're a lighter portfolio company, you will have some of that reporting function because we provide them both. So that's good. Then there's a lot of housekeeping items, right? Make sure you have a clean cap table. Make sure in Kata you can pull up the report. If you have investors at some point, make sure they're going to be aligned with you on an exit. So you have them aligned. There's things like, IP assignments, whoever worked for you, make sure the IP is assigned back to the company, consultant or contractors. If you have used people in India, Romania, wherever, make sure, again, on chain of control, they can go with the buyer. Then again, perception matter, right? When you're selling a house, you want a house to look clean. So when you're going to market 2 or 3 years down the road, make sure your Glassdoor reviews look good. Make sure your G2 reviews look good. People look at that. Am I at a 4.8 against Zendesk, right? How you reviewed in G2.
People are looking at Glassdoor. Acquirers are looking at
Yeah,
Glassdoor.
because they look at cultures, right? Your culture 3.0 is a toxic place. Maybe I don't want to get into that, right? So, look at these are small things. G2, Glassdoor, make sure all that is good. Understand, who your team is going to be, who's going to be involved in the process, right? Make sure your legal contracts are good. Make sure your change of control, with any customers are not going to create an issue. Make sure you don't have any ROFRs. Make sure you have good corporate counsel. And then, a data room is ready. And your advisor, can get engaged with you, even if it's 2 years down the road, can guide you, or at least someone on a friendly nature can guide you to watch for these things. And then there are things like sales tax issue. Like in the US, you can sell your software in 50 states, but you haven't been collecting sales tax. Well, guess what? The buyer is going to say, that's not my problem. I'm going to, I want indemnity for this, right? So small things like that can creep up on you and create problems for you and detract from the exit. So if you're prepared, you're going to get the best value and the optimal buyer. But if you're not, it's going to take away from the value. And I encourage folks to read that white paper. We wrote it over time. You have QSBS in the US, many other things we wrote about. But I think those are things that people can kind of prepare for.
We'll put the white paper up in the chat when we publish the podcast, but I've seen often that IP assignment come up and I've never seen it kill a deal, but I've seen it drag it out and rack up a lot of legal fees as you're chasing that ex-employee and trying to get the assignment, and it can actually cost a lot of money too at the time. So that's really good advice. Colin, anything to add to that?
I would say a lot of the prep work that needs to happen probably is more aimed at bootstrapped companies. I think generally companies that have got some form of institutional capital invested already have already started that journey of being well structured and prepared for an exit event. For bootstrap companies, the number one thing that we'll step into, particularly when they're saying, "Oh, we'd like to go to market in 2 months," is the quality of management information just isn't up to par. So if you're 12, 18 months out in terms of your thought process, just make sure your monthly reporting's accurate, but not just from a financial. Make sure you're starting to capture your SaaS metrics that will go to the quality of the business and therefore value. So, making sure you're tracking those, making sure you're building the investment case as you go along. That's probably the number one. And then it's personal tax as well. Are there things that you can be doing from a personal standpoint to structure this in a way that optimizes your tax outcome? If you're doing 12, 18 months out, you've got time to make changes.
Yeah. What's your advice on managing confidentiality with your employees, your customers, and even competitors during a sale process?
M&A by nature is a very discreet process, right? Only people who need to know should know. I think, employees generally get worried if they find out a process is happening, like what's going to happen to my job. So our advice to the company is generally limited to the CEO and maybe one person with the CEO. Could be a CFO or a co-founder or maybe a CFO. With customers, there's no need to involve them, right? At some point, the buyer is going to say, I want to speak to your customer. We're like, sure, you can. We'll do it in exclusivity. We'll do it after we got draft of purchase agreement and we are 2 weeks from closing. Because then the surety is pretty high. They've gone through the diligence, there's less risk of the deal falling apart. And no, you're not going to talk to all customers, maybe a few, right? And sometimes even the script with the customer is they want to partner with them, they want to invest with them, or even we do blinded customers call where we use a third party who just calls them up and say, are you happy with this, right? And it depends on the situation, but that's how we do the deal with the customers.
Yeah, keep it tight. Keep it tight with the employees. Only keep it to those that need to know, because the more uncertainty you create within a business, it's not great for the day-to-day sort of functioning of the company. In terms of sort of commerciality with competitors, you've got to be sort of alive to the fact that you could go into and this is particularly when they're obviously an obvious acquirer, is just be mindful of what information you're sharing as you go through the process. Really sort of take a lens of, if this deal doesn't happen, have I just given away all of my secret sauce to them? And there's ways of managing a process as you go along to sort of really ensure that even if it does fall over at the 11th hour, you've taken all the appropriate steps. And there's concepts of sort of black box due diligence, and that's where there'll be items within the due diligence that the buyer can't see, only their advisors can review, for example, and sort of lean on your advisor to sort of help you through that process, as to make sure that you don't step into sort of a process where all of a sudden it falls over and you've left yourself with a huge commercial risk hangover for your company going forward. So that's probably the thing just to be mindful of, is just taking a lens as to who gets what. And not all bidders need the same information at the same points. Private equity, you can probably take a view that they're not there to set up a competitor to you. They're there to invest behind you. But a trade buyer could have a very different approach. So don't always think everyone needs the same information at the same time.
Yeah, one thing I'll add to what Colin also said was, the competition tends to be a great buyer for you because they know the synergies, they know where, they can add value. So we always talk to the client if they want to go to them, but we recommend going to them much later in the process, get a couple of strong bids and see if this competition is going to come in and like top it. And then, you can kind of get them into the process later on. And if they don't top it, like Colin said, don't give them the information.
I like the idea of having, and I would imagine that's mainly around IP, having their advisors review it versus the company, the potential acquire themselves. On that note, how often are you, when you're working on the sales side, requiring a breakup fee?
Breakup fee, we have some clients who ask for it. We say almost never, unless it's a multi-billion-dollar deal, which is I'm talking about, like Figma had a break fee like 5 million or what, 5 billion or whatever. Right? Figma had it and they got a big payout from that. Wiz had a big breakup fee because they were worried with this deal not happening. But anything below $500 million, you're not going to see a breakup fee.
Really? Oh my gosh. I was really good. Told my company I negotiated a big breakup fee.
Well, you were lucky.
That was a while ago though. Yeah. I mean, I just think it takes so much time from the founder and a lot of times the team. And if the company's just kicking the tires, for me, it's like the best indication that the company is actually serious, right?
Done it probably twice in deals below 100 million, but it was like they really wanted to buy it, and the breakup fee was like, okay, they knew they were not going to pay it because they were going to buy it, but it's very rare, and you can do searches in various databases. It's very atypical. And Colin, I know E&Y works from mid market to high end, but good to get your views.
Yeah, I mean, the sort of the break fees are typically more in the listed company environment,
Yeah.
in truth. It is rare in the private sort of M&A market. And I'd say, by the time you sort of start negotiating the terms of a break fee, you actually are investing legal costs to sort of try and determine what's the sort of the break fee agreement. You're wasting time in many respects and then if they're a savvy buyer with a sophisticated lawyer, they're going to negotiate terms within that break fee that means that they can walk away and still not be on the hook to pay it. And once it gets so diluted, it can become worthless. We occasionally see it. I think there's other ways of protecting yourself through a process.
The one way you protect yourself to that point, which Colin said, is give a short exclusivity window. Maybe give an exclusivity window for 3 weeks, which renews only if you give a draft of the purchase agreement, right? If you know it's going to be tight. Otherwise, exclusivity falls apart. That way, you're not spending 6 weeks, 3 months on this. So give these milestone dates exclusivity.
To manage it with the exclusivity window versus a break fee. Yeah. So one question that we get asked often by our lighter capital portfolio companies when they are considering selling and thinking they might hire an advisor is what will it cost? What's the process to hire an advisor, and how much is it going to cost me if I use an advisor versus trying to sell the company on my own?
That's a common question that we'll get. I would say, particularly for someone that's new to appointing an M&A advisor, you won't get that initial sticker shock. It's always going to be more than what you think it is. And I think what you do need to do is, cutting across the sort of self-interest that I'll have in this, is probably do speak to 2 or 3 advisors just to get a sense as to what is the sort of appropriate range of pricing that you'll have to pay for an advisory firm, or speak to other people that that have been through the process as well. You'll probably will know founders that have appointed advisors to sell and get a sense as to what could be a market rate. But I'd also say don't necessarily go with the cheapest. Just because you go with a cheaper firm or a cheaper pricing, you probably got to question why. And cheaper generally does not mean better, by the way, the quality of the advice that you're getting. So you've got to weigh up the pros and cons as to how much you're going to pay. But what you should do is step back and sort of ask yourself, is this advisor going to deliver me more value on the table for the business that I'm selling? And if that answer is yes, then you're going to be comfortable that whatever you're paying them, you're going to get more by way of value and benefits from appointing them that almost sort of makes the fee irrelevant in many cases. So, do your homework. That would be my advice. And certainly sort of make sure that you do stress test what the pricing is that you're getting.
That's great. And Colin, one more thing I would add is when you're working with a bank, ask them if the managing director is going to be your point of contact and he's going to pick up your phone calls, or you're going to be delegated to an associate who's going to answer your phone calls. I've worked at bulge brackets, and oftentimes if a deal is not big enough, the managing director is not picking up the phone call. The associate is learning on your nickel. And do you really want somebody who's maybe 5 years out of school with a business school degree trying to sell your business, which is your life's earning? Or would you rather have a seasoned managing director who has a lot of deals behind him, being the guy who's kind of leading your deal. So that's one. And then, as Colin said, if you pay your advisor $1 million or $2 million, but if the value goes up $5 or $10 million due to a process, it's well worth it. And at the end of the day, you are paying for advice, and advisors in the market does this for a living. Any managing director will sell between 2 to 10 companies a year. You, as a founder, selling one company every 5 to 7 years, they have this experience on your side. A corp dev or a private equity firm are buying 50 companies, right? There's tax against you. You don't know what's market. Having somebody on your side to guide you through the process is invaluable. A lawyer will only come in with the purchase agreement. They're not there in your marketing process, in soliciting LOI and getting all of that stuff. So having someone who can help you, it pays for itself.
I think just the one other thing I'd say is you should also, yes, certainly look at the pricing, but also review your advisor in the aspect of, are you going to want to work with this person for the next 6 to 12 months? If you think about the individuals that you're engaging with, you're probably going to be at points speaking to them every day, speaking to them at weekends. Is this someone that you actually want to work with and then trust in actually, delivering you some generational wealth? And so pricing is one thing. The relationship aspect is actually key as well.
Yeah, you rely on that advisor so much during that process as a counselor, not just helping you with your business sale. Thanks again to Gaurav and Colin for joining our podcast today. And to learn more about Allied Advisors, visit alliedadvisors.com. And to learn more about EY, visit ey.com. We hope you enjoyed this episode of Bootstrapped, the Lighter Side. To receive future episodes, subscribe using your favorite podcast platform. And if you enjoy this show, please share it with other fellow founders and entrepreneurs. For more insights, helpful tips, and to learn more about founder-friendly financing options, visit us at lightercapital.com. That's LIGHTERCAPITAL.com.